As the old saying goes, April showers bring May flowers. And April was quite the rainy month for the market. It has been an extremely volatile start to the year, with the S&P down almost 15% and the NASDAQ down over 24% year to date. We've experienced the worst start to the stock market since 1970. The fixed income has not been spared either, registering the worst performance in almost 50 years. So, with all of this rain, you may be asking, will May bring flowers? The good news is that the market is a leading indicator. So much of the sell-off we've seen to date was in anticipation of some of the economic data that's now being reported.
Consumer Price Index, which is a lagging indicator, is expected to have peaked, and actually the 10-year break-even inflation rate supports this hypothesis. Of course, time will only tell as more inflation prints are published. Annualized GDP is expected to come in at 2.3% in 2022 and 2.1% in 2023, which are downward revisions to previous estimates, but still above 10-year historical growth rates. With all the uncertainties around inflation, economic growth, geopolitical tensions, and lockdowns in China, not to mention midterm elections in November, we expect markets to remain extremely volatile throughout most of the year.
While the sell-off is telling investors that we should expect a slowdown in economic activity, it does not mean that a recession is imminent. There are several significant economic factors that are working in our favor. Wage growth is quite strong and unemployment is at historic lows. GDP, while reduced from prior quarter levels, is still healthy. Corporate earnings for this quarter have been quite strong despite inflation headwinds. Looking forward, the market's performance will be dependent on whether the Fed can start to cool off inflation with interest rate hikes without materially slowing down the economy. Until then, we expect volatility to continue and likely to be tied to the release of key economic data and FOMC commentary. While it can be absolutely gut-wrenching at times, these are the type of markets where high-quality, well-balanced portfolios tend to outperform. We are embracing the volatility by harvesting losses where appropriate and regularly rebalancing your portfolios to stay true to our investment discipline. As always, please reach out to our office with any questions or concerns.